What if I told you that beating Wall Street at its own game doesn't require a fancy finance degree, insider tips, or even the ability to read a stock chart like a pro? That's exactly what Peter Lynch, the legendary investor and author of One Up on Wall Street, believed. His groundbreaking book isn't just an investment manual. It's a roadmap for everyday people to spot life-changing opportunities hiding in plain sight. Whether you're in a coffee shop, grocery store, or scrolling through social media, Lynch's philosophy teaches you that the best investment ideas are often right under your nose. Forget the jargon, ignore the noise, and dive into the simple, timeless wisdom of a man who turned everyday observations into a legendary stock portfolio. In this series, we'll unpack the top lessons from One Up on Wall Street. Lessons that are not only practical and profitable, but surprisingly entertaining too. Because let's face it, if you're going to learn about investing, it might as well be engaging. Peter Lynch, in One Up on Wall Street, categorizes stocks into 6 distinct types. These categories are like tools in an investor's toolbox, each suited for different goals, strategies, and risk tolerances. Whether you're chasing explosive growth or seeking steady returns, understanding these types can guide your decisions and help you avoid costly mistakes. 1. Slow growers. Slow growers are mature, established companies that grow their earnings at a modest, predictable pace, often in the low single digits annually. These businesses have typically reached their peak growth and are found in industries like utilities, large retail chains, or consumer staples. While they won't make you rich overnight, they provide stability and steady income, often through generous dividend payouts. This makes them ideal for conservative investors or retirees who prioritize reliability over excitement. Think of these companies. Its value might not double anytime soon, but its dependable dividends can act as a financial cushion during volatile market periods. Lynch warned that you shouldn't buy slow growers unless they offer an attractive dividend yield. They're like a tortoise in the investment race. They won't win any speed awards, but they'll still cross the finish line steadily and securely. These companies are also less sensitive to market ups and downs, making them a safe harbor during economic storms. 2. Stalwarts. Stalwarts are the middle ground between slow growers and fast growers. These are big, well-known companies that dominate their industries and deliver dependable earnings growth of around 10 to 12% annually. Companies like Coca-Cola, Johnson & Johnson, or PepsiCo are classic stalwarts. They're household names that have been around for decades, with strong brands and consistent profitability. Lynch loves stalwarts because they're resilient. During recessions or market crashes, they tend to hold their value better than other stocks. They're not going to deliver massive returns like fast growers, but they're a great way to preserve wealth while steadily growing it over time. If you're looking for dependable performers that offer long-term value, stalwarts are a great fit. As Lynch said, these stocks might not make you a millionaire overnight, but they'll help you sleep well at night. 3. Fast growers. Fast growers are the most thrilling category of stocks. These are companies growing earnings at 20% or more annually, often in rapidly expanding or niche markets. Think of Amazon or Tesla in their early days. Small or mid-sized businesses that are scaling up quickly and redefining their industries. The potential here is enormous, but so is the risk. These stocks can turn into 10-baggers if you pick the right one, but they're also prone to higher volatility. Lynch stressed that fast growers need to have a clear growth strategy, strong management, and realistic valuations. While their rapid reinvestment of profits means they rarely pay dividends, their growth potential can make up for it. However, Lynch warned against buying fast growers that are already overpriced. Look for companies that are still underappreciated by the market. These are the racehorses of the stock market, and while they're exciting to own, you need to do your homework to separate the winners from the pretenders. 4. Cyclicals. Cyclicals are companies whose performance rises and falls with the economic cycle. These businesses thrive during periods of economic growth and struggle during downturns. Examples include airlines, automobile manufacturers, and steel companies. Investing in cyclicals requires careful timing. Buy them when the economy is in a downturn and sell when the economy is booming. Lynch compared cyclicals to roller coasters. If you don't get off at the right time, you'll lose your gains. While they can deliver big returns during economic recoveries, they're not for the faint of heart. For instance, an airline stock might double during a travel boom, but collapse during a global crisis. To succeed with cyclicals, you need to understand the industry's dynamics and anticipate the economic cycle. 5. Turnarounds. Turnarounds are the comeback stories of the stock market. These are companies that are currently struggling due to poor management, market changes, or financial trouble, but have the potential to recover and deliver significant returns. They're often undervalued by the market because of their challenges, making them high-risk, high-reward investments. For example, Best Buy was once considered a dying retailer due to online competition, but a strategic overhaul in leadership and operations turned it into a success story. Lynch referred to turnarounds as no-growth stocks that suddenly become growth stories again. To identify a good turnaround, look for a company with clear catalysts for improvement, like new management, restructuring, or shifts in market demand. While turnarounds can be risky, they're worth the bet if you can identify companies with a solid path to recovery. 6. Asset plays. Asset plays are companies whose hidden or underappreciated assets make them valuable. These assets could include valuable real estate, patents, inventory, or even equity stakes in other businesses. The market often overlooks these assets, giving savvy investors an opportunity to buy the stock at a discount. For instance, a company might own undeveloped land in a rapidly growing urban area, and the true value of that land isn't reflected in its stock price. Lynch loved asset plays because they required deeper research and patience, but the payoff could be massive once the market recognized the hidden value. These stocks aren't for those seeking quick returns, but for patient investors, they can unlock significant wealth over time. Peter Lynch's 6 categories of stocks provide a clear framework for analyzing potential investments. Whether you're drawn to the stability of slow growers, the excitement of fast growers, or the hidden potential of asset plays, knowing these categories helps you approach the market with a focused strategy. As Lynch famously said, know what you own and why you own it. By understanding these categories, you'll not only build a smarter portfolio, but also avoid emotional decisions that can derail your long-term goals. Understanding the 6 categories of stocks gives you a solid foundation for building a diverse portfolio. But if you're aiming for exceptional returns, you need to dig deeper. That's where the 13 traits of a 10-bagger come into play. While the categories help you classify stocks based on growth potential and risk, these traits act as a checklist for identifying the rare gems that can multiply your investment tenfold. By combining these 2 approaches, you can not only categorize your investments wisely, but also uncover the standout opportunities hiding within each category. In One Up on Wall Street, Peter Lynch popularized the term 10-bagger to describe stocks that increase tenfold in value. Finding one of these rare gems can transform your portfolio, but they don't come easy. Lynch believed that certain traits could indicate whether a company had the potential to become a 10-bagger. Here's a detailed look at the 13 traits he suggested investors should consider when hunting for these extraordinary opportunities. One of the key traits Lynch emphasized was simplicity. The best 10-baggers are often found in companies with straightforward business models. If you can explain what the company does in one sentence, you're off to a great start. Complex industries or overly technical products make it harder to gauge long-term growth potential, and Lynch preferred to stick with what he could easily understand. Another critical factor is the company's size. Small-cap and mid-cap companies are the most likely candidates for 10-baggers because they have room to grow. A large, well-established company might already dominate its market, leaving little space for exponential expansion. If you're looking for massive returns, focus on smaller businesses that have yet to hit their stride. Growth potential is another crucial element. A true 10-bagger often operates in a growing market where demand for its products or services is rising. Lynch advised investors to identify businesses that could scale significantly over time, whether by expanding geographically, launching new products, or capitalizing on a niche market. Companies with room to grow are the ones most likely to deliver tenfold returns. Management also plays a significant role. Lynch believed in investing in companies led by passionate, competent leaders who had a clear vision for growth. Companies with innovative and driven management teams often outpace their competition and succeed in volatile markets. Look for leaders who are focused on execution, not just hyping the stock price. Financial health is another critical trait. A potential 10-bagger should have manageable debt levels, strong cash flow, and reinvest its profits wisely to fuel growth. Too much debt can act as a drag on a company's ability to scale, and poor financial management can turn even a promising business into a failure. Pay attention to how the company allocates its resources. Smart investments in infrastructure, R&D, or marketing can signal a long-term growth strategy. Pricing also matters. Lynch often pointed out that the best 10-baggers are underpriced when you buy them. This doesn't mean the stock is cheap in a conventional sense, but that the market hasn't fully recognized its potential. Finding an underappreciated company with strong fundamentals and buying it before others catch on is key to reaping tenfold returns. The industry plays a role as well. Lynch found that many 10-baggers come from unglamorous or overlooked industries. Businesses that sell everyday products or services like paint, auto parts, or even donuts often provide fertile ground for 10-baggers because they avoid the speculative frenzy seen in more exciting sectors. Another indicator is insider ownership. Lynch preferred companies where management had a significant stake in the business. When insiders own a chunk of the company, their interests are aligned with those of shareholders, and they're more likely to make decisions that drive long-term growth. Earnings growth is also a cornerstone trait. A 10-bagger typically shows a steady increase in earnings over time. Consistent growth signals a strong underlying business model and indicates that the company is successfully scaling its operations. Check the company's past performance to ensure it has a track record of delivering on its promises. Product differentiation is another trait to consider. 10-baggers often sell a product or service that sets them apart from competitors. This could be through innovation, a unique business model, or a strong brand. Companies that solve a specific problem better than anyone else are often poised for massive success. Market penetration is a crucial factor. Many 10-baggers start small in a localized market and gradually expand to a national or even global level. If the company has already saturated its market, the likelihood of exponential growth diminishes. Look for businesses that still have plenty of untapped opportunities to explore. Cyclical resilience is important too. While some 10-baggers may operate in cyclical industries, the best ones tend to have the ability to perform well regardless of economic conditions. Companies that offer essential products or services often fare better during downturns, making them safer bets for long-term growth. Lastly, Lynch believed in the power of patience. Finding a 10-bagger is only half the battle. You also need the discipline to hold on to the stock long enough to see it multiply. Many investors sell too early, missing out on massive gains. 10-baggers often take years to materialize, so staying the course is crucial. By focusing on these 13 traits, you can increase your chances of spotting a 10-bagger before the market does. Lynch's advice boils down to a mix of observation, research, and long-term thinking. While 10-baggers are rare, they're out there, and if you take the time to understand these key traits, one might just land in your portfolio. While understanding the 13 traits of a 10-bagger can help you identify stocks with extraordinary growth potential, knowing the 5 traits to avoid is equally critical. Spotting a promising stock is only half the battle. Avoiding companies with red flags ensures your portfolio remains resilient and free from costly mistakes. Together, these principles offer a balanced approach to finding winners while steering clear of losers in the stock market. Peter Lynch not only guides readers on identifying winning stocks, but also stresses the importance of avoiding certain red flags that can lead to disastrous investments. Avoiding mistakes is just as critical as finding great opportunities, and Lynch's insights help investors steer clear of common traps. Here are the 5 key traits you should avoid when evaluating stocks. The first trait to avoid is a company with a complicated or unclear business model. Lynch famously avoided businesses that were too difficult to understand. His philosophy was simple. If you can't explain how a company makes money in one sentence, then you probably shouldn't invest in it. Complex business models often obscure risks or inefficiencies, leaving investors in the dark. For example, a company dabbling in multiple unrelated sectors or relying on overly technical or speculative innovations may lack focus and long-term viability. Simplicity and clarity are hallmarks of a business that can succeed over time, while excessive complexity often signals trouble. The second trait to avoid is excessive debt on the balance sheet. Debt in itself isn't inherently bad. It can be a useful tool for growth. However, when a company carries too much debt relative to its earnings and cash flow, it becomes vulnerable to economic downturns or rising interest rates. Lynch emphasized that companies with manageable or minimal debt are far better equipped to navigate tough times and reinvest in their growth. Businesses burdened by heavy debt often end up prioritizing repayment over innovation or expansion, which can stifle their ability to compete in the long run. Checking debt-to-equity ratios and interest coverage metrics is crucial when evaluating this risk. The third red flag is companies that rely heavily on storytelling rather than performance. Lynch warned against falling for companies that sell a dream without backing it up with solid numbers. These are often referred to as story stocks because their appeal lies in an exciting narrative, such as disrupting an industry or launching a revolutionary product. However, a compelling story without tangible evidence, like growing revenues, profitability, or a clear plan for scaling, is often a recipe for disappointment. For example, many companies during the dot-com bubble promised to revolutionize industries, but failed because their businesses weren't profitable or sustainable. The bottom line, no matter how great the story sounds, the numbers must add up. The fourth trait to avoid is poor or misaligned management. Lynch believed that strong leadership is essential for a company's long-term success. Management teams that lack focus, overpromise, or prioritize short-term stock performance over building value are major red flags. Additionally, avoid companies where executives don't have significant stakes in the business. They lack the incentive to make decisions that benefit shareholders. Lynch was particularly wary of CEOs who focused more on public relations and stock market hype than improving the company's core operations. He advised investors to look for leaders who are disciplined, focused, and aligned with shareholder interests. The final trait to avoid is companies in declining or oversaturated industries. No matter how well a company performs internally, operating in a dying industry puts it at a significant disadvantage. For example, companies tied to industries like coal mining or physical media, example, DVDs, face structural challenges as demand dwindles over time. Similarly, entering an industry that's already saturated with competitors such as ride-sharing or streaming services makes it difficult for even a well-managed company to carve out significant market share. Lynch encouraged investors to focus on industries with room for growth rather than those fighting for survival. Peter Lynch's approach to avoiding these 5 traits is as much about protecting your portfolio as it is about growing it. His advice is a reminder that great investing isn't just about finding winners. It's about minimizing mistakes that can derail your financial goals. By steering clear of companies with these red flags, you can focus on opportunities that are truly worth your time and money. In the world of investing, the key to long-term success lies in balancing opportunity with caution. By understanding the 6 categories of stocks, identifying the 13 traits of a 10-bagger, and avoiding the 5 red flags, you equip yourself with a comprehensive framework to navigate the market with confidence. Peter Lynch's wisdom reminds us that investing isn't about chasing every trend. It's about staying disciplined, doing your homework, and making informed decisions. Whether you're aiming for massive returns or protecting your portfolio from pitfalls, these timeless lessons are your roadmap to smarter, more successful investing.